recording and hand over to Richard. Richard, over to you.
Okay, thanks, Joe. If you can move on a slide. As Joe's mentioned, I'm a director at Willis Towers Watson, based in Leeds. About 20 years of DC consultancy experience gained, mainly within large firms, covering most aspects of DC delivery. And usually wearing a tie on that photo seems to be a rarity for me at the moment. If you could move on to the next slide, Joe. So just breaking down our agenda, we'll start with some hot topics. Perhaps surprisingly, given the pandemic, there's been a lot of DC regulatory announcement over recent months. So I thought that'd be a good starting point just to consider some of those latest updates. Appreciate that might be a refresher for some of you, but nevertheless, hopefully helpful. We'll then take a look at some extracts from the Willis Towers Watson FTSE 350 DC survey, including contribution levels, the at retirement challenge, types of DC vehicle used, and then finally we'll consider collective DC, what's happened so far and what's expected in the future. Okay, so let's get started. If we move on to slide 5, looking at the recent hot topics, and in no particular order, just try to brainstorm in terms of what I thought would be interesting. So let's start with the DWP consultation on consolidation. So what we're going to see here is quite a ramp up in the testing on value for members. So occupational DC here. So DWP has announced new measures to improve outcomes for members of DC schemes. So the plans will push through consolidation amongst smaller DC schemes by requiring trustees to consolidate if they can't demonstrate value for members on quite a wide holistic basis. The DWP also seeks to encourage the wider use of illiquid asset classes by larger schemes, and these measures are intended to take effect from the 5th of October next year, and building on proposals in a consultation back in February of 2019. And I think it's fair to say that the government has long held reservations about the governance standards in smaller trust-based schemes. Much of its recent work sought to nudge trustees to improve standards or move members into vehicles with better governance. And these latest measures certainly up the ante, with the government proposing that the smaller schemes, and by smaller, they're talking about those defined with assets under 100 million, carry out and report on a revised value for members assessment. So new schemes accepting that they take time to build up scale, and they're exempt for 3 years. But the assessment will look at a combination of cost charges, net investment returns, 7 other measures of good governance, such as quality of record keeping, communications. And the measures state that where schemes are not able to demonstrate that value for members under the new assessment, trustees should take immediate steps to wind up the scheme and consolidate members into a larger scheme, unless in exceptional circumstances they can either improve that VFM rapidly or demonstrate rationale for continue of the current scheme. So all schemes, regardless of size, must publish net returns for their default and self-select funds in the annual chair's statement. The DWP will publish statutory guidance requiring the net return figures to be shown as annual averages, and the figures for the returns are to be shown for investment performance from 2015 onwards, where possible. So smaller schemes will have to compare themselves with 3 other larger schemes, one of which must be capable of receiving a transfer in of benefits. A further addition to the BFM is measuring the trustee knowledge and understanding across the whole board, and the regulator will be providing new statutory guidance to assist in this respect. So schemes will be required to carry out this assessment annually, to include it in the chair's statement and to report the results to TPR as well, with plans for improvements if they are necessary. So in addition, all schemes, regardless of size, must confirm their scheme's monetary value. So this is quite a step up in terms of governance requirements, and the focus particularly on those so-called smaller schemes. Okay, so what else have we got on here? We've got within that consultation as well the charge cap proposal. So currently DC charge cap of 75 basis points, 0.75, can make it difficult for schemes to pay performance-related fees and invest in illiquid assets. And a review of the cap is ongoing. So that's looking at how funds can blend in a proportion of illiquid assets and integrate the charges within the cap. The government clarifies here that in this review it will seek to give trustees sufficient assurances that they're able to make long-term investment decisions. I think the ongoing threat of constant review has prevented trustees pushing on with these types of investments. The government's also planning an easement in the way that there's pro-ratering of charges and how that operates to exclude the performance element of the fee where members leave or join partway through a year. So to access funds such as venture capital, the government's also looking at developing a rolling multi-year approach to performance fees. Okay, so potentially a little bit more flexibility to accommodate those illiquid investments there. What else have we got? So we've got pension dashboards. So indicative timeline has been published. So the pension dashboards programme, the PDP, has confirmed that it's on track to deliver the initial version of data standards in December this year. So over the next 6 months, PDP is looking to identify the first set of volunteer pension schemes to provide data from 2022 with compulsory staged onboarding plan from 2023. So PDP has also published some research into understanding the challenges different types of schemes may face when integrating with pension dashboards, and a summary of the responses to the call for input on data standards. So I suggest it's worth taking a look at the PDP website if you haven't already done so. There's a progress report which was published last month. It includes a high-level activity plan, and for the enthusiasts out there, you can even sign up for a monthly PDP newsletter. Okay, so what else have we got? We've got simpler annual benefit statements for workplace pensions. So government's published its response to the consultation on this. It's minded to mandate the use of a simpler statement template for DC schemes used for auto-enrolment. So further consultation expected later this year. I understand DWP is also in favour of a statement season, and will take responsibility for SMPI assumptions as well. So looking to align these with the FCA's key features illustrations where appropriate. We've also had some guidance for rules for those accessing flexible pensions, just some tightening here. And the DWP has confirmed that it will require schemes to take proactive steps to facilitate pension-wise appointments for members with flexible benefits. So remember their money purchase, cash balance benefits. And what they've seen is that in trials, offering to either book an appointment for the member or transferring the member to the money and pension service to book an appointment significantly increased take-up of guidance. But the DWP does want to allow trustees to choose a process that works for them best and their members. So TPR is expected to provide guidance on this. In addition, members will need to confirm that they've either taken pension-wide guidance or opted out before they can actually draw flexible benefits. So DWP consultation on the regulations expected, no timescales actually being given beyond the earliest opportunity, I think they've said. Hot topic throughout, pension tax relief, potentially come back on the radar through the course of this year, given the financial constraints within the pandemic. So Treasury's responded to the Public Accounts Committee's recommendation that it evaluate the impact of pension tax reliefs by saying it will continue to engage with stakeholders to understand the pension tax regime's impact. continue to gather evidence through consultations, but it doesn't think now's the right time for a formal evaluation. So that's being pushed on, and I know that was mentioned over the summer, potentially as an opportunity to raise tax revenues, but that clearly is off the agenda for now. The statutory review of auto-enrolment costs of accrual tests is expected before the end of year. There was a call for evidence published in September, and that statutory review of the DC alternative quality requirements as well, expected before the end of the year. We've also had in September government confirming the intention to increase the normal minimum pension age from 55 to 57 from 2028. So that will be aligned with state pension age as well. And from then on, will be pegged at 10 years prior to state retirement age. Okay, so I think we've covered everything on that slide. So aimed as a quick update on the main topics. So yeah, if we move on now to the DC survey, probably skip on it again. If you just go back one, if you wouldn't mind, Joe. So just thinking about the FTSE survey, so the WTW FTSE 350 survey, you may or may not have come across this before. It is published each year. The 2020 version was published in the summer. On some of the slides, we also include data from previous years, just so we can identify trends there. We do try and obtain data from as many of the organisations which make up the index as possible. Many are clients, many are prospects, but bear in mind we don't have responses from everyone, but typically we do have a large percentage coverage of the index. And of course it does reshuffle as well each quarter, so that can account for some changes in the data year on year. So what I would say is, whilst the results are based on those very large companies, the largely publicly quoted companies in the UK, we do believe they're relevant to any employer with a DC arrangement. So Joe, if you move on to slide 8, thanks. So starting with contribution rates, the responses were drawn over the first half of this year. So bear in mind that some will have been submitted before the UK lockdown commenced. Most organisations also do tend to pay on base pay, but some also pay on qualifying earnings or other definitions. And we can see that only 5 or 6% of organisations think they're likely to enhance current DC rates. So perhaps not too surprising, probably largely a reflection on auto-enrolment reaching steady state of contributions last year. And of course, as we've moved through 2020, given the pandemic, if anything, the expectation is that perhaps these numbers might have reduced slightly. If we can move on to slide 9, Joe. Here we just break down the contributions over the FTSE 100. So we can see that we've got 4 years from 2017 there. So employer core contributions, if we think about a typical DC contribution structure, where we have a core level of contributions, and on top of that, perhaps a matching scale. Well, employer core contributions average 6.8%, with member contributions averaging 2.8%. Those matching contribution structures offer members the opportunity to receive further matching up to 4.6% from their employer, for an average additional 3.3% in member contribution. But they have broadly stabilised. We can see since 2017, we've only had approximately a 1% rise in employer contributions. If we move on to slide 10, just looking now specifically at the FTSE 250, FTSE 250 contributions have increased over that period, but from a lower starting point. And many have needed to do so to comply with the AE regs. So in total, an employer contribution rate of up to 9.3 compared to that 11.4 for the FTSE 100. What is interesting though is that nearly 9 in 10 companies use the minimum contribution rate under their own scheme's design as their default entry level. So it's not to say that all companies are using the statutory minimum design required, but it does provide anecdotal evidence that unless individuals understand the options available and take action, those additional opportunities for extra contributions might be being missed out on. Of course, the elephant in the room here is the pandemic, how the crisis will impact our economy and the way we live and work in the future. Could we even be at high water mark for DC pension? Could the global slowdown put pressure on contribution levels across the board? We just don't know at this stage, but fiscal tightening seems inevitable, and any potential review of auto-enrolment contributions now, as I mentioned earlier, seems unlikely. Okay, so moving on now to at retirement support and what we call the retirement challenge. If you skip on to 12 as well, it is encouraging. If we look here, we can see that more than a quarter of FTSE 350 schemes are very or extremely likely to enhance their retirement support they offer members. So it appears to be the top area of focus, with over 1 in 4 companies in the FTSE 350 looking to do this. So the FCA's review of the retirement outcomes did highlight the challenges members face in choosing their own benefits. So contract-based providers now required to provide far more support, and we do see many companies looking to supplement this even further. Many trustees looking at new ways to help members get the best value from their savings. The increased use of apps to support members alongside web tools also helps members in being able to access the information how they want and what they want. So we work with a number of companies and trustees where perhaps wanting to implement IFA support, and that can typically involve both DB and DC, or either on a standalone basis. So moving on to 13, the majority of schemes in our survey offer some level of support to members approaching retirement. So we just break it down here across the different DC vehicles. They tend to do that through a combination of a bundle provider's own proposition and the employment of a third-party service. So a notable change this year is the growth in the number of own trust schemes offering facilitated access to a nominated third-party drawdown provider, perhaps in recognition of the continued popularity of this option for retirees. Although around a third of trust-based schemes do allow access to member-paid advice service, very few have so far made use of the £500 pension advice allowance available to fund this. So it would appear on the face of it that many employers and trustees are missing out on providing access to financial advice by taking advantage of this tax-efficient option. It's essentially a tax-relieved contribution to pension advice. Okay. Okay, so moving on now to DC vehicles, and skip on to 15, Joe. So almost half of FTSE 350 companies have hard-closed DB schemes, and a quarter have only ever offered DC. So what it means now is that 7 in 10 employers are now providing DC for all of their employees. So how do they go about delivering that DC? If we move on to the next slide, we can see that companies have chosen to continue to operate trust-based arrangements, have looked to do so as efficiently as possible. So we can see that nearly 9 in 10 FTSE 350 DC arrangements are now bundled with investment management, day-to-day admin undertaken by the same provider, regardless of the wrapper under which they're delivered. So contract-based being bundled, master trust bundle 2, does mean that the market, the FTSE 350 DC market, is made up primarily of bundle schemes. So breaking it down now in terms of what type of delivery vehicle they tend to use. If we move on to 17, Joe, the survey shows continued use of master trusts. So you can see we've used the last 3 years here. That trend towards master trust does continue. It's relatively slow and steady, but I think it's remarkable that master trusts do now represent chosen delivery method for nearly 1 in 4 companies across the whole FTSE 350, given it's only a little more than 7 years since they entered the mainstream market. And our expectation is that that trajectory will continue. There is still a good proportion of FTSE 350 companies that have indicated that they are likely or extremely likely to change the vehicle they use in the next 2 years. Okay, so if we move on to 18. So the pandemic may drive further acceleration towards those packaged solutions like master trusts as businesses look to further delegate scheme governance and also cut the cost of provision. We do see a number of drivers behind the shift to master trust. I talked earlier about the proposed expansion of the value for members assessment and the regulator targeting so-called smaller schemes with less than 100 million of assets. We also find that companies and trustees too are also attracted by enhanced member experience in outsourced DC arrangements. And of course, the authorisation framework, the 2018 changes in the regs covering transfers without consent, they've all played a part too. Okay, so certainly expectation that those trends towards master trust bundled arrangements will continue. Okay, I'd like to move on now to the final agenda item, collective DC. Whilst I'm not you can skip on, Joe, if you can. Whilst I'm not a CDC specialist, so knowledge is limited, do see it as an exciting example of innovation in the DC space, and one which could potentially see significant growth in the future. So collective defined contribution, CDC, is a new type of employee retirement provision under which employers pay a fixed rate of contributions into the scheme and members are paid pensions with variable increases. The law is due to change to allow UK employers to open a CDC scheme for employees potentially from next year, 2021. So this will then create that third option for employers alongside defined benefit, or if we can call it individual defined contribution pensions. So key advantages are that the cost would be fixed. So employers' pension budgets wouldn't need to vary year on year. Secondly, expected pension levels are high, and this is driven by the pooling of assets. So for a given contribution rate, the expected CDC pension is significantly higher, so 70% higher than from buying an insured annuity with an individual DC pot, 40% higher than provided under a typical DB scheme. So significant step up, as I said, for a given level of contribution. So if we move on to the next slide, thanks, Joe. Just thinking about, what would the drawbacks be? Well, so pension costs can be fixed. Pension levels must be variable. So CDC does differ from DB and insured annuities in this regard. So CDC scheme design and governance will need to take care to ensure that the benefits are being determined in a way that's transparent and fair to members. Also, member expectations, so member communications will need to make it very clear that pension levels or their rate of increase may go down in some years and could be smaller than expected across retirement as a whole. There is also an element of preference here. And if an employer wants to provide an annual income in retirement, it's probably going to be most cost effective and at a fixed cost to do it through CDC. Okay, so some employees might prefer to be able to make decisions about how to invest and draw retirement savings through pension freedoms, introduced in 2015, in which case an individual DC pot might be better for them. So if you think about the demographic analysis that might go on alongside a investment review for a DC scheme, identifying trends in terms of that retirement expectations, I think what we would be doing is looking at the membership as a whole, whether providing a pension in retirement as a target is going to meet the needs of that population. So initially, employers wanting to provide CDC would need to do so through their own standalone trust-based arrangements. So that in itself is perhaps seen as a barrier to entry. So employers with very large workforces, we would suggest at least 5,000 employees would be best placed to open a cost-effective CDC scheme. In time, further law changes could enable CDC multi-employer schemes or master trusts, so making CDC more accessible for other employers. And for me, that's the particularly exciting area of the CDC developments, the potential scope for master trusts in the future. So if you are interested in knowing more, please look online for our Willis Towers Watson guide. It covers 15 key questions on CDC, including how they work, advantages, drawbacks. We've touched on some of those this morning. The results of that analysis of expected CDC levels and views as well on the types of workforces best suited to CDC. So if we skip on to the next slide, we can just see an indicative timeline here. CDC regulations are likely to be in place to allow employers to open CD schemes from a point in 2021, with the Royal Mail being the first planned scheme. Government has said it is keen in time to allow industry-wide CDC schemes, or for pension providers to set up CDC master trusts. So that would make CDC much more accessible to smaller employers, even the self-employed has been mentioned. Further regulations obviously be required for this, and we expect that it wouldn't be an option to do so until at least 2022 or beyond. Okay. So that completes the slide. I hope you found that content interesting. I don't know, Joe, whether we've had any questions come through so far, but happy to take any of those questions now.
We haven't had anything come through just yet. Please, if you do have any questions, then please pop them into the chat. They'll come through to me, and I'll put them to Richard. I suppose to kick us off, one question from me is on the issue of future tax relief for pensions. I know you said that it's been moved off the agenda for now. There's obviously quite a long time left in the term of this government, and so how likely do you think it is to come back onto the agenda during this government's term, and sort of secondly to that, if perhaps it's not likely, or even if it is likely, how likely is it that they might try to simplify the system that we've got at the moment? Because I think there's a general consensus that the tapered annual allowances it's far more complicated than it needs to be.
Yeah, absolutely. And I think what we see is year on year now this coming onto the agenda. So focus on review of tax relief, perhaps the inequalities within that system. We've also seen a lot of commentary at the focused on the net pay anomaly in terms of those lower earners under 10k not being rewarded with tax relief. So I think it's likely to continue that focus. I would expect that probably we will see a formal review from this government at some point. I think the pressure will come to bear eventually on it. And as you mentioned, the issues with tapered allowance, accepting that they did extend the thresholds for that earlier this year, but I expect that would come back. So I would expect to see a review of tax relief at some point in the short to medium term.
Thanks, Richard. We're still a bit sparse on questions, so please do put your questions through. I'll carry on while actually there are a couple coming in, but I'll pose another question then. It seems the past 10 years have been something of an easy ride for DC pensions. A 10-year bull market. People generally see the value of their investments going up, and it looks like the period that we're going into is going to be quite a different period from the one that we've just been through. What do you think is the real challenge on the horizon for DC pension provision, and what do you think we can do to overcome it?
Yeah. Okay. So I think through the course of this year, we've seen some quite significant volatility, obviously, in investments, and those savers that are focused more with an equity content in their savings pots have seen more volatility. We've seen trustees and companies try and ramp up communications in that context. I think where we've got lifestyle target date funds in place, hopefully they've delivered in terms of what they were designed to deliver. Okay, so I think it's just making sure that members understand that. In terms of I think the elephant in the room with DC is always paying sufficient contributions to provide a sufficient retirement income. So in terms of managing expectations, I think the dashboard will play a role in terms of communicating overall benefits there. But I think the biggest challenge for any DC member is to be saving sufficient money to deliver a good outcome for them in retirement. So I think continuing to maintain a high level of communications. I think what we've seen through 2020 as a consequence of the pandemic is that a lot of the providers, particularly the bundled providers, have been challenged to ramp up their digital proposition. So we saw some providers challenged around the initial stage of lockdown, perhaps unable to deliver helplines, given the work from home requirements. But across the board now, we've seen providers really ramp up their propositions. So perhaps digital investments that were on the wish list have been accelerated. So we've seen a number of providers come to market with apps. As I say, ramping up the communications with members. So hopefully that will reinforce the importance of DC for those members, and help them understand where they are in terms of the DC journey, and those tools also help them understand what they need to do in order to deliver a better outcome at retirement. We've also seen video benefit statements help that point. Helping members understand what they have in the pot in a different medium, accepting that members like to see a variety of mediums, helping them understand what they've got in the pot and perhaps what they can do to improve those outcomes.
Okay, question here about adequate saving rates for retirement. The question asker quotes a figure of 20% to be an adequate saving rate, or possibly higher if members start to save later, and that's obviously much higher than many people are saving. So what can we do to bridge that savings gap?
Yeah. Okay. So well, I think we've seen a variety of things today that hopefully will come to market in terms of the DC journey. The likes of the improvements in the overall member experience that are often delivered through some of the master trust propositions with that digital investment are helping members on that journey. In terms of that 20% figure, I think that would be a reasonable figure. I think WTW carried out some research about 4 years ago, and 15% really would be a minimum threshold to deliver an acceptable level of retirement income. So it's something that as a member, I don't think that would be a common level of benefits across a scheme. So I think it's just reinforcing to the membership the importance of maintaining that sort of level of benefit within a lifetime of saving, coupled of course with state benefits as well, possibly other savings supplementing retirement income.
Okay, thank you. A question about how are AVCs under final salary schemes impacted by the new DC requirements?
Yeah, okay, so those new DC requirements that we talked about under consultation earlier, so they would be relevant for DC schemes with relevant benefits. So in other words, do you provide a chair statement would be the primary question. So if you've got pure AVC benefits, it's unlikely that you're going to be affected. It's worth just looking closely at that, just to check whether there are any other DC benefits held within the scheme. Sometimes it might be appropriate to seek legal advice on that. But we're talking about DC relevant benefits, and I think the primary question, hopefully you would know the answer to by now, is do you need to provide a chair statement? Are you providing a chair statement, in which case you'd be caught? Otherwise, those DB AVC schemes wouldn't be affected.
Okay. And what is your view as to the level of governance in the DC trust world? Too much or too little?
Yeah, well, I think what we've seen is the regulator continually ramp up requirements on those trust-based arrangements, and to introduce the bar at 100 million, I think is indicative of their intentions here. So, looking potentially to focus trust-based provision on those very large entities. So I think it's become quite difficult to successfully deliver compliance with the pension code without significant time, focus and investment in an own trust arrangement. So I think in terms of delivery of chair statements, they become more challenging. I think they've moved away from their original intention. They've become quite significant in length. Particularly the knowledge, trustee knowledge and understanding sections have become quite challenging to complete in line with TPR expectations. So as a consequence, we've seen clients where with the best intentions, they've got to the point where they've looked and made a decision, look, do we want to go with this for the future? The expectation is that the regulator will continue to build on these requirements. Does the own trust benefits the opportunity to bespoke our scheme, be very focused on our membership requirements? Does that outweigh these TPR requirements? Perhaps what would the alternative be? So we've seen a number of trust-based arrangements consider feasibility papers in terms of, okay, what would the alternative look like? And we see trustees sometimes being quite defensive through this process, but we've also seen trustees actually, when they get into that process, be quite surprised perhaps at the level of engagement that comes with a bundle proposition, perhaps through master trust. We've certainly seen significant focus on looking at what the alternative might be, given that ongoing growth of TPR expectations and requirements.
Thank you, Richard. That's all of the questions that we do have in the chat box. So if there are no more, then I propose that we will wrap it up there. Thank you to everyone that's joined this morning, and special thanks to our speaker, Richard. This morning's session has been recorded, and we will pop it on our YouTube page, and we'll link to that through our section of the PLSA website. So if you have any colleagues that couldn't make it but would like to see a recording of today's session, then please point them in that direction. Details of our next session are being finalised, and we'll send that round in due course. And lastly, just to say, in terms of CPD register, as with last time, if you would like to pop your name and the word CPD into the chat box, that'll come through to me afterwards with the recording of today's session, and we can use that as the CPD register for today's session. So thanks again for joining, and thanks again to Richard for being our speaker. Have a lovely day, everybody, and stay safe.